Welcome. My name is Kieran. I'm the Head of Aviation Advisory for KPMG, and in conjunction with Airline Economics, I'm delighted to bring you to another session of our Aviation Leaders Report for 2024. I'm delighted today to be joined by Tom Baker. Tom is the CEO of ACG, a hugely significant presence in the sector. And Tom, maybe you might take a minute or two just to give a little bit of background to ACG.
Sure, thank you, Kieran, and thank you for the opportunity to join you today. Aviation Capital Group is a top 10 lessor based in Newport Beach, California, wholly owned by Tokyo Century, our parent. We own, manage, and have committed a portfolio of approximately 500 million aircraft, so about a little over 300 owned, 60-ish managed, and about 100 in order book of 130 aircraft. Primarily focused on new technology narrow-body aircraft, selectively invest in wide-body aircraft, with about 90 customers in 45 countries around the world.
No. And speaking of those customers, what's your perspective on how airlines are performing and that performs across different markets?
So certainly far better tailwind over the last 18 to 24 months than clearly we saw during the pandemic. Sporadic, obviously nature blooms at different rates in different places. So coming off very, very strong two-year period in the United States, in terms of we see where these markets opened, experiencing enormous growth, resurgence post-pandemic, unsustainable, just rates of change. So returning to more, first it's winter time, so returning more to a seasonal dynamic, and secondly returning to more normal rates of growth. So natural, call it slowing, but still supportive dynamics there. And that's the United States, that's Europe, that's certain places in Latin America. Asia, obviously, certainly slower to come back online, coming back online, perhaps with less velocity than we had hoped or expected. Still positive, the slope in the line is still positive, but perhaps less upward slope than we had expected. But again, this opportunity is allowing networks to come back online, allowing airlines to make some money and improve their capital position. So certainly more of a tailwind, but there will be players that will continue to try and improve their position, but whose networks, fleets, capital structures have been significantly impaired. That they will continue to struggle even in a better environment. But broadly speaking, I think the airlines are doing much better. And
that tailwind, do you think the current, are there any macroeconomic issues you're concerned with, or clearly all of the geopolitical issues we have at the moment, do you think that will have an impact?
Certainly to some extent with certain players, and depending on where one is in the world. And again, the susceptibility. If airlines with very fragile networks, with very challenged capital structures, a cold breeze could certainly send them home with a cold. Fuel, everybody loves to talk about fuel. There's been some volatility around it, but generally speaking, it's been moderately behaved. Labor is an issue. Obviously, higher rates. Currency fluctuations. I think what we're seeing is certainly there have been some dramatic movements in each one of those individually. It's where airlines are challenged is the collective increase, and particularly in the United States, we're seeing the accumulation of labor, we're seeing the accumulation of fuel costs, we're seeing just everything, inflation ticking up, higher lease rates. That when you add them all together, that's really where the challenges are. It isn't one particular; it's the accumulation of the collective increase across those factors.
And they're clearly kind of driving demand side issues, but obviously we have supply side issues. And how are you seeing the supply side in relation to aircraft, both in the secondary market and new deliveries, and how is that impacting asset values?
Sure. So the industry will face significant supply constraints for the foreseeable future due to OEM delays, due to end manufacturer challenges, supply chain constraints, so on and so forth. Ironically, growth will be a challenge.
Yeah.
Access to metal will be a challenge. For us, ACG, it's just something we will need to manage.
Yeah.
But to your point, in terms of creating demand for available capacity, existing metal, we are seeing increases in asset values. We are seeing strong demand in the secondary market, trade sale market, despite the higher rates. We would have expected to see in such a high volatile rate environment, secondary market trading activity to feel a little bit of it and slow down a little bit, but we're seeing very strong bids in the secondary market.
Pretty good. Sorry.
So it is, we would prefer an orderly, orderly OEM manufacturing delays. You order it now, it's expected here, it delivers here, and move on. But in this current world, there are ways for us to manage that, and there are ways for us to continue to improve the profitability of our business despite the constraints, but growth will be a challenge.
Yeah. And obviously a subset of that then is kind of on the engine side and the challenges there. And how do you see that, like, is that really going to start to pinch the airlines and the lessors in the next while?
I think it certainly impacts or should impact the credit underwriting of airlines in particular, in terms of what is their exposure to the Pratt & Whitney engine, how much of the fleet is powered by Pratt & Whitney engines, and then again, do they have the capital structure? Do they have the excess metal? Do they have FMP programs or other things to support them? Do they have strong parental support? What is their ability to absorb the unexpected shock of 9, 12 plus months of downtime and the unexpected costs that come with that? And then even if they do, even if they do ultimately get that support, does it come when they need it? So I think the way we think about it, it really is a huge factor in how we think about the credit and the underwriting at the airline level.
Yeah. And we've high interest rates, at least in comparison to the shorter medium term. And what do you think, or what impact do you think that's having? And do you think it's having an impact on lease rate factors?
For sure, having an impact on lease rate factors. Everyone talks about the lag. Certainly, that has been an observable phenomenon. Higher rates. So this is one where ACG might have a slightly different perspective than some of our other peers, in the sense that higher rates do create financing challenges, but they also force discipline. And I think higher rates should force our industry, our peers, to truly understand the real cost of capital. And that should create, again, more discipline around pricing, more discipline around the competitive dynamic of fleet in terms of sale leasebacks or repricing, second lease, third leases. So ACG, I think, would be in the camp where we're ready for higher rates. We do believe that they will be around, but we believe it will accentuate our competitive advantage. When spreads were low, when rates were compressed, very hard for that differential between lessors, disciplined lessors with flexible capital structures, disciplined pricing. Very difficult for us to differentiate itself when everything is compressed so tight. Now that things are really starting to differentiate, we think we'll outshine.
And when you say discipline, is that in relation to good process, good controls, good understanding of your balance sheet, essentially, good technical teams, good sales teams, but ultimately being good at leasing as opposed to having capital?
Exactly.
Yeah, okay, very good.
Exactly. And it's, for a durable leasing platform, it's more than that first placement. It's what's the investment thesis of that asset over the life of that asset. And so how do you think of your cost of capital over the life of that asset? Is this a hold to maturity? Is this a sale in year 6? How am I going to transition that to that second player? And then do I have the technical team? Do they have the marketing, remarketing team? Do I have a relationship? Do I have a presence? Do I have relationships with the MROs? Do I have relationships with the OEMs and the suppliers? That's a full service global platform. And I think that in a low rate environment, when there was plenty of access to metal, the barriers to entry were artificially low. Yeah. And the competitive constraints were suppressed or easy to ignore for a period of time.
Yeah, because I think that'll be interesting. I think what you're, if I'm getting it correctly, what you're saying is the strength and the quality of lessors will come to the fore now, because just having access to cheap capital isn't a differentiator anymore. It has to be better.
Exactly.
Yeah.
Exactly.
And I suppose thinking about the debt markets a little bit, what's your sense on the assessment of the current position of the debt markets? And again, we probably think about three pillars. We have your traditional capital markets piece, your traditional lenders, and your new alternative lenders.
And we are an alternative lender, so I'm biased to the positive on that. And I'll start with that one because I think that strategically makes a ton of sense for lessors in the sense that we underwrite that risk all the time. We know the metal, so structuring secured financing based on the metal is just something we do all day anyway. So whether it's a finance lease or an operating lease, it's a lot of the same process. So that makes a ton of sense. I think people don't appreciate how hard it is to make money off money, and so I think we're going to see that play out over time. But I think it allows us to be relevant to the fleet team. It allows us to be relevant to the finance team. We show up with an ability to solve 100% of their fleet financing solutions. So that makes sense. Other lessors have realized it. We'll continue to see that. We also believe that it will be harder for traditional banks to continue to finance the aviation sector the same way. So we will be stepping in and filling a need for all the reasons people talk about, whether it's higher capital, the cost of capital, or having to hold more on the balance sheet for regulatory reasons. Or again, underwriting aviation at capital committees that are based in New York and Paris freak out from time to time when they're, where there are certain defaults, and so there are just banks are risk on or banks are risk off from periods of time. And then in terms of capital markets or access to financing, lessors, particularly corporate lessors, so those are lessors with investment grade ratings that finance at the corporate level, not at the asset level, not captive warehouses. So we are often ambassadors to capital, ambassadors to the capital markets for the benefit of airlines, those without relationship lending banks, those without public ratings, those who cannot finance the capital markets. And so for us, the capital markets are strategic in the sense that we can move quickly, we can finance the capital markets, we have deep relationships. It's a very systematic and repeating process. Capital markets, the bond market is always open, asterisks, with the exception of a couple weeks per crisis, but the capital markets are always open. And so we believe that pool of capital provides us a competitive advantage and then allows us to then help finance the aviation sector indirectly, providing access to the capital markets to our airline customers. Long-winded way of answering your question.
No, perfect. And so that's the debt side. On the equity side, are you seeing kind of new types of investors? And how do you think the aviation assets are kind of standing up as an asset class versus alternatives?
Yeah, so the great news is that aviation and aircraft finance is a great industry. Great industry, it's a great opportunity. It's become harder, it's become more complex, and it's become more competitive. But it's still a phenomenal investment thesis around aircraft leasing and investing in the metal. So that's the good news. The bad news is it's compelled a lot of other new capital to run in, and then particularly because of the pandemic, when you have a lot of private equity and others looking at distressed opportunities, that capital has flown in. And it's also, when money sloshes around, it further distorts the competitive dynamic.
Yeah.
We are still going through that. And new players are still coming in. I think they're starting to realize that this comes back to picking quality partners,
Yeah.
this comes back to underwriting discipline, and this comes back to understanding the investment thesis over the life of the asset. So people hopefully they're smarter about it, or they're going to need to get smarter about it. But again, because it's a great space to invest, because it's a great way to invest, we will continue to see equity come in.
Yeah, and they can always just go get great advisors, obviously, as well.
Yeah, or they could partner with
Exactly
great deployers of capital,
Exactly.
and let us be stewards
Yeah.
of their LP capital. But yes.
And I suppose, post-pandemic and during the pandemic, we saw the percentage of lease fleets kind of move upwards, if that makes sense. What's your view on that for the medium term? Do you think that trend will continue, or are there maybe signs that there might be other options for airlines?
It's a metric that everybody loves to quote. It's far more nuanced, as you know. So in the United States, I think the leased fleet is, someone told me 30%, Latin America it's 80%, Asia probably, low-cost carriers, and so it's probably close to 90 or 100%. So that really distorts that aggregate 50 that everybody likes to quote. I do think that, again, because a lot of the airlines had to burn the furniture in the pandemic, do what they needed to do to stay afloat. Capital structures are stretched, access to aircraft is constrained, and so those with access to capital, or those who can provide capital to help finance growth for airlines, or those with access to metal, will continue to play a very important part. And in the shorter term, that will continue to drive up leased fleet as a percent. And so, yes, the dynamics for the lessor community are actually quite favorable right now. But I don't think, it will continue to fluctuate around some sort of mean. Is that 45? Is that 50? Is that low 50s? Who knows? But the dynamics are pretty favorable for the lessor channel right now.
And maybe turning back a little bit to the internal quality and discipline and control, and sometimes having size or scale is helpful to give you the ability to put all those processes and structures in place. So we've seen scale, become more important in the last while. Do you think that will continue, and do you think that might drive some M&A?
So scale is certainly important. I think scale. But I think people, when they hear the word scale, they go right to number of aircraft. And again, I think scale speaks much more to that. It speaks to, again, a global technical global marketing network, access to different markets, an understanding of different markets, a network of lawyers who can help you when things get. So scale is really, the quality of the global platform writ large. To be able to support that kind of complexity, that kind of sophistication, all that people, yes, you do need to have a certain of aircraft, a number of aircraft under assets under management to justify the investment in that platform. That used to be $5 billion. That $5 billion became 8 to 10. That became 10 to 12. I think we skipped right over 15. So I do think you will see the top 10 lessor community navigate much more. I don't know where the fat of the curve is, but it's probably high teens, low 20s, either now or soon. And so yes, so I do think and we're a maturing industry, and so you do naturally see, as industries mature, the key competitors do scale. How do they scale? Inorganic growth is typically in maturing environments. M&A, inorganic growth, is a key way for competitors to do that. And so I do think, again, when you have a lot of money in our space, growth constraints, again, because there's no new metal coming, tougher competition, and just a more complicated environment. I think all of those factors are driving forces of consolidation, so you will see more M&A in our space.
And maybe changing tack a small bit, ESG and particularly the E, right, has been hugely important. How do you see that evolving over the coming years?
Yeah, I think it's critically important. I hope we keep the momentum going. I'm obviously biased, but I think the lessor community has done a nice job rallying resources around ESG initiatives and have internalized a commitment to driving change. We're a long cycle industry, so for the E part in particular, we're a long cycle industry, and we're learning technological change is very hard, from development to industrialization to proliferation. And so practically speaking, SAF is really the most actionable thing that we as an industry can do. And so I think a lot of people are rallying around that. It's not perfect, but I think over the nearer term, I think we should continue to do those efforts, and the lessors should continue to prioritize that. So it's coming, but it'll take a long time, and unfortunately, it will be slower than we all want. But again, we're seeing in other industries, there's there's a little bit of a slower, things are slowing down on the ESG front for a variety of different reasons. I hope on the aviation side we continue to keep moving forward on that.
I'm just going to pause for a second, sorry. Sorry, pardon me. I've only one left on you. Okay, so I'll get back. So Tom, looking over the next 12 months, what's your level of optimism?
So I read an article that said optimists live longer. So I've decided against every fiber in my body that I will be an optimist. I think that, and it's been a tough few years, so it's easy to feel. But I am optimist. I'm an optimist, and I'm very optimistic on the next 12 months. Not in the sense that I'm very optimistic that things are going to be great. I'm optimistic that aviation had our recession. And so we are just returning to a more normal growth, more normal over a period of time. And we are a GDP plus, sometimes a GDP plus growth industry. And so when you think about coming from a low base, and so we're just trying to replenish that growth we didn't have for 3 years. When you think about the global economy growing 2.5%, that suggests maybe kind of 5-ish plus percent growth in aviation on a global basis, with some fluctuations around. So again, and supply constraints and all those other things, hopefully to create a more orderly market around that growth. That sets up nicely for I think for long-term profitability for aviation. I think 2023 will be the high watermark in the sense that we need to get through this winter, but I am constructive for 2024 spring summer travel season, and I think that it is going to be more normal growth. But I think that those who plan well and those who are prudent should be able to make money next year. We think about our cycles as typically 5 to 7 years. The last one was 9-ish. And I think this current upcycle started, call it end of 2021. And so we're in the second or third inning of the next upcycle. And if that generally holds, 24, 25, and 26 are going to be the fat of the cycle. And that's the way we're committing our investments right now. And that's the way we're organizing our people and our priorities, is we are setting the table. We've had a really good quarter this quarter. We're going to have a good quarter next quarter. 23 is going to be good for us. But 2024, 2025, and 2026, we believe are going to be the fat of the next upcycle.
Brilliant. Well, on that very positive note, I'd say thank you so much for your time and your insight. Thank you everyone for watching, and again, thank you to Airline Economics for supporting this initiative and our program. Thank you very much, Tom.
Thank you, Kieran.
Great.